So a lot of you have asked how I find companies to go into my watch list. So in this video, I'm gonna share with you part of my process and a potential gem I've added to my watch list. Just so you know, my process is very much like a piece of software. It's constantly getting updated and tweaked, and I'm hoping that by sharing it with you, you get some ideas for your own process as well. To build on that, I've spent time reflecting and updating my own investment style. So I want to give you an update on that as well. If you have any feedback on what I could do better with my own process, let me know in the comment section below. As usual, I'll do a portfolio update in this video as well. And no, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. So without further ado, let's go. The first thing I want to talk about is an update on my investment style. I started off as a dividend growth investor, mainly looking at ETFs or individual stocks that will grow its dividend over time. The whole idea here is passive income and the compounding growth by reinvesting those dividends. It's relatively safe for me because the companies are really mature. So at best, I might just perform at market returns. At worst, my portfolio wouldn't really change that much. And a combination of listed investment companies and ETFs make up the bulk of my portfolio. Literally, there was only 3 positions I had when I first started investing. Then as the pandemic broke out and we went into shutdown mode, I realized that there was a once or twice a lifetime opportunity to invest in growth companies that are unfairly punished and will exponentially grow my wealth. Tesla and AMD are a great example of that. Not only were they misunderstood, they were also unfairly punished during that period. I've shared my thinking around why I think they are misunderstood in my old videos. And I have to say, a bit of due diligence mixed in with a bit of luck have made these positions pan out more positively than I would have hoped. So then it became obvious to me that while it's good to have a portion of my portfolio in safe assets like ETFs or listed investment companies, the true power of investing lies in allocating capital in companies that will exponentially grow my wealth. And that's why throughout last year, if you've been following me for a little while, you can actually see my portfolio change to reflect my new investment style. And I might as well do a quick portfolio update now. As you can see, I have one pile of safe stuff that is essentially listed investment companies like Argo, WAM Research, and then an ETF that tracks the entire US market. It's quite a big portion of my portfolio, and I like to think of this almost like the foundation of my portfolio. At best, I'll perform at the level of market returns. At worst, this portion of my portfolio is probably not going to move too much, and it's just going to grow steadily. And then I have another portion of my portfolio dedicated to high quality companies that I think will exponentially grow my wealth over the next 5 years. Now, this is a relatively small portion in the CMC market portfolio side of things, and I'll show you my stake portfolio in just a second. Just a quick note, I'll be adding Asia into my portfolio very soon, and it's mainly for the reason I've documented in my high growth ETF video. And also, a few of you have also asked what exactly is this tool I am using. This is called ShareSite. It's just a portfolio tracking tool that I use that makes my life easier instead of trying to use spreadsheets. I'm not sponsored, but if you do want to try ShareSite yourself, I've left the link in the description box below. Now with my stake portfolio, it's worth about 40,000 US dollars, which is give or take a little bit more than 50,000 Australian dollars. Now, that's a big chunk of my overall portfolio, and the same logic applies here, except I've decided to only dedicate my stake portfolio for high quality growth companies. So I'll be cleaning out my portfolio a little bit to make room and also focus on companies that I believe that will exponentially grow my wealth over the next 5 years. But as it stands, not many things have changed. I literally have not made any changes here. Everything is still exactly the same. My core holdings are still exactly the same. Okay, it's easy to point out at things that I did pretty well last year, but what about the things that I didn't really do a good job at? Now, spending time reflecting upon 2020, I realized that because I'm trying to be less wrong over time, I'm able to identify massive tidal waves that are going to lift up most boats because the waves is so big. But because those waves are so big, the level of returns is very much dependent on what price you're paying to get on those boats. And that's one thing I really struggled with last year. Quantitatively, I found it really hard to gauge value in these small cap companies. Not to mention, I think my decision-making process is actually quite fuzzy. That's why I found it really hard to pull the trigger on companies like Vulcan. So this year, I'm trying to be better with my quant skills and be a little bit more open-minded towards technical analysis so that I'm getting a more realistic view of what's happening in the markets. Okay, next. Quite a few of you have asked how I filter out companies to go on my watch list. One of the ways I've documented is in my video how I plan to invest in 2021. I generate a top-down view of the world, structural trends if you will, and then a bottom-up analysis of companies that are best suited to ride those waves. Now feel free to check out this video after this one. But sometimes, even though I've done the analysis, the companies might just be out of my price range. So while I wait for companies to come into the price range, what I like to do is look at the most shorted stocks on the ASX and see if there are any insider buying activity amongst that group, and then look for value there. The hypothesis is that if some funds are betting on these companies declining in the future in order to profit off them, if insiders or institutions are buying more as the share price decline, that's a contrarian signal I'm looking for. Because to me, that seems like there is more to the story than what it seems. So let me take you through an example. Now this website is called Shortman. It's basically the top 100 most short stocks on the ASX. It's updated regularly. And what I like to do is I will take some of these companies, and usually I like to do the top 50, and I will go through the ownership tab of Simply Wall Street. So I will just type in, like for example, let's say we're looking at EML Payments. And then I go to the ownership tab. So as you can see here, there are more buying activity than selling activity. To me, that's a contrarian signal. And it seems like there's more to this story than what it seems. And by looking through the top 50 of these, what I found is that 4 companies on that list actually seems like there's more to the story than what it seems. Now, I think it's important to point out that the ownership tab on Simply Wall Street sometimes just doesn't reflect the most updated information. So for your and my sanity's sake, I actually double checked the ownership changes on asx.com.au as well amongst that 50 companies. A good example of the ownership tab not doing a good job reflecting the true information is that if you go to Zip, go to the ownership tab, and then you look at the last 3 months of insider trading activity, there's nothing here. But we know that's not true, because if you go to asx.com.au, you can see that there is a change of director interest notice. Larry Diamond and Peter Gray have actually added to their position. So that's why it's important to take whatever you see on Simply Wall Street with a grain of salt and double check that information on asx.com.au. Anyway, it's up to you whether you want to go the extra mile to check. But I did, and I'm going to focus on EML Payments for this video. Now, EML is the 17th most shorted stock on the ASX with almost a 7% short interest. But if you look at the insider trading volume, you can see that this is telling a completely different story, even though this company is being shorted. And if you look through who's on the buying side, you can see that Retail Employee Superannuation Trust, and then you have Morgan Stanley First Sentier is just going for it. Actually, a big volume is coming from First Sentier. So to me, the first question is the First Sentier funds going to EML, is that a passive fund flow or is that an active fund? Now, the difference between the two is that for passive, it's just basically tracking an ETF, and EML is part of ASX 300. So it's not consciously choosing to invest money in EML. That's why I'm asking that question. And from a Google search, it seems like these two funds are investing in EML, and these are active funds. So because it's an active fund, it's a conscious choice to go down this path. So to me, that's enough of a contrarian signal to tell me that there is more to this story than what it seems. And then from this point, this is where I start to get interested. I tend to dig deeper into their numbers and also the business. Now, before I show you my somewhat decent quant analysis, EML Payments is a fintech company, and they make majority of their revenue via prepaid gift cards, reloadable cards, or even banking as a service. Now, the market opportunity, according to the CEO, is massive. The US prepaid market is a $395 billion market. The EU market is projected to reach 371 billion by 2023. And Australia is about a 1.1 billion market. As of recording this video, EML have said that the gross debit volume is about $13 billion, which is approximately close to 2% of the global market. So there are plenty of room for them to grow into a titan. The bear thesis to me seems like because people can't use their prepaid gift card in shopping centers, well, because they can't even go to the shopping center, EML are going to have a tough time generating revenue, not to mention the uncertainty around vaccine rollout. Who knows how long it's going to take EML to recover. But their 2021 Q1 update seems like to me that they're doing just fine and their metrics are improving all across the board. Revenue almost doubled compared to the previous year, not to mention on a quarterly basis, it's up 20%. EBITDA is doubled compared to the previous year and it's up 69% compared to the previous quarter. Now putting the Q1 update aside, you can see that the revenue have grown very fast over the last 10 years. And the gross margin, this is almost like a software company type gross margin at above 70%. And over time, even though they did have a tough time in 2020, well, arguably, they're still generating a lot of cash flow. If you look at the operating cash flow margin and also the free cash flow margin. And if we break things down on a per share basis, you can see that EPS is growing, but it's still a very much work in progress. But the amount of free cash flow the company is generating is quite healthy. Not to mention the amount of revenue that's growing on a per share basis is relatively healthy as well. It's really up to you in terms of how deep you want to dig. But the fundamental seems like to me that even though they are hit, it doesn't seem like they're really that impacted. Together with their FinLab investment in Intercheck and Hydrogen, EML Payments is essentially buying distribution channel for their own product, not to mention potentially adding new products into their product suite to broaden up their ability to monetize their audience. Frankly, to me, the downsides of EML Payments seems a bit overblown. The fundamentals of the business is sound, and it seems like they're recovering already. And that's why I've added them onto my watch list. Now I hope that by sharing my process with you, you've gotten a better understanding of how I think and how I filter out companies to go on my watch list. And if you want to support this channel, not to mention be part of my fortnightly Q&A and access to extra content pieces, consider supporting this channel via Patreon. Nevertheless, if you have learned something new, consider gently smacking that like button right there. Subscribe to my channel so that when I release future videos, you'll be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.